So on Friday, February 2nd, the stock market dropped by 666 points and followed up with Monday, the Dow dropping an additional around nearly 1,200 points. I think it was 1175. So what prompted all this? This is the question that people are asking most frequently, asking us. And this is just, again, a very short little presentation discussing, what was behind that rapid drop off. And today's Tuesday, February 6th, and the market was back up again. It hasn't gotten back all of its losses, but it has moved up in the right direction. So again, looking at what happened last week or Monday, through Monday that caused the market to drop so drastically. First off, the Fed, as in the Federal Reserve, their FOMC, the Federal Open Market Committee, met last week, last Tuesday and Wednesday, and they opted not to drive up the targeted, or raise the targeted federal funds rate, and they opted to hold off on really discussing it any further. They had said that they've been talking all along. They're planning on raising the Fed funds rate over the course of this year, doing at least, I would say, 2, 3, maybe even 4 increases, half point apiece perhaps, or maybe less. So at any rate, that's been kind of the talk, the water cooler talk, so to speak, with the Fed. But needless to say, again, Wednesday they came out. That was Janet Yellen's last time as chair, and also being on the Fed itself. That they are not going to raise the Fed funds rate. That was their monetary policy decision. So, at any rate, that was again midweek last week. So Friday, that was the first Friday of the month, and the first Friday of the month, what happens is that we get the labor report typically, and this was the labor report for the first one for the year 2018 for the month of January. And the numbers came in very strong, and it's an odd month because they're making up for previous months, and there are a lot of changes that are going on. But needless to say, it ended up with a very strong number in terms of the payroll numbers came in at about 200,000, and also the employment so far as the current population survey came in above 400,000. I believe it was 409,000 were added to the ranks of the employed. So very good news. So that's one piece of very good news. Secondly, we got news from BLS, the Bureau of Labor Statistics. Again, who are also those folks who reported on the employment on Friday, also came out and talked about wages for the year 2017, and wages increased by, I believe it was 2.6% in 2017 overall, which is a very, very healthy increase in wages, kind of the best numbers that we've seen in quite some time, especially on an annual rate, looking back to the 12 months. So that was good news. So we've had two pieces of good news. And finally, we also had news from the Atlanta Fed. All the Atlanta Federal District, the Federal Reserve Bank of Atlanta, the district bank, they came out with a forecast where they're looking at the first quarter 2018 coming in above 5%. I believe it was roughly 5.5% growth rate, if it was on an annualized basis for the first quarter in 2018. So that would be phenomenal. Just keeping in mind that the last time that we had 3% or better for a year goes back to 2005. So this would be a portent of good positive economic growth. So we've had three great pieces of news. Those three pieces being, again, the employed being up significantly on Friday, the wages on the rise for the year 2017 quite a bit, and finally the forecast for GDP growth is, again, coming from the Atlanta Fed, showing significant increase in growth for the first quarter of 2018. All good news. So what prompted the sell-off in the stock market on Friday and also on Monday, yesterday? So all we have to do, of course, is look at why would the market do this, and the rationale behind it is actually fairly straightforward. Their concern is that the Fed is would be prompted to drive up interest rates, and the reason that they would do that, of course, would be to their response to inflation, or more to the point, in this case, we're talking about the prospect of inflation, because if we look at the inflation for last year, for the year 2017, the overall inflation number was just above 2%, which is fairly mild inflation. So that in and of itself wouldn't provide a rationale, if you will, for the Fed to drive up interest rates. But the Fed has been looking at this for quite some time, with interest rates being as low as they have been, in particular the Fed funds rate. That's the one, of course, they control. It's the rate in which banks, or the market in which banks borrow and lend between amongst each other to provide loans. We'll talk about that again at some other later date. But again, to kind of get our arms wrapped around this, it was the reaction in the stock market, the tremendous fall off in prices on the stock prices on Friday and Monday. First off, the numbers were large, but the percentages were kind of in the normal correction area, if you will, percentage-wise. And I think the last time that we've had any sort of correction in the market, and oftentimes corrections come for a variety of reasons. This is one we can put our finger on the Fed for this, for sure, or the anticipation of the Fed's actions coming forward in the next meeting, upcoming meeting in March. But the last time, I think, goes back to 2016, early in the year, maybe February or so. Again, the exact timing kind of escapes me, but it's been quite a while since we've had that go. So it's been roughly 2 years, 24 months, maybe 23 months since we've had this type of a correction. So again, kind of in summary, what we're looking at is that the reason that we had this drop off in the stock market, the stock prices, the stock market dropping so significantly, has more to do with the stock market itself surmising, guessing, anticipating an increase in interest rates so far as the Fed is concerned. Very, very, very straightforward. And again, I guess today rather, I haven't really looked at the number, but I think we're back up. Point is that this is kind of the point of departure, if you will, when we look at we've had these terms kind of bandied about quite a bit over the last couple of years, Main Street and Wall Street. This is kind of the departure, if you will. The stock market not liking or being timid, being afraid of the economy taking off, and the prospect of inflation, and so the reaction, of course, is that in response to the potential prospective reaction by the Fed in becoming more aggressive in terms of raising interest rates. So this is Wall Street's reaction, but Main Street, meantime, we've had very good news so far as labor markets in particular, and also the prospect of GDP increases going forward and real economic growth going forward. So we'll see what happens. So I guess what I'm saying is that bottom line is that don't panic, and today kind of lends credence to that with the market coming back, but who knows what's going to happen tomorrow. The point is, again, don't panic and just kind of sit tight. If you're in the market, don't turn and run, don't cash out. And if you do have cash, now perhaps is probably a good time as any to jump into the market and try to catch things at lower prices. So we'll talk more in the future. Thank you, and keep your eyes open on the website. Thank you.